Hey, welcome to the New Home Insights podcast by John Burns Real Estate Consulting. I'm Dean Worley, your host. Each episode, we're going to bring you some of the best minds in the housing business talking about some fascinating topics or trend or innovation or issue, just like the one you're about to listen to. Enjoy. Hi, this is Dean Worley with New Home Insights, the John Burns Real Estate Consulting podcast. Today, we have a guest from Starwood Land Advisors, Mike Moser. Mike, how are you doing?
I'm doing very well, Dean. How are you?
I'm good. Today, we're going to talk a little bit about, pretty much focus on land and, of course, the residential market and development. Maybe get into a little bit about build for rent, just a bit, at least in terms of how they compete within the land environment, and get kind of a good, and also talk a bit about Starwood. So let's start there, Mike, if that's all right. Just tell us about your role there and maybe a little bit of history of Starwood Land going back to, I think, 1991 and the S&L crisis and how you came to where you are today.
So great. Thanks, Dean. So I spent 13 years at what is now known as Taylor Morrison. I was there from about 1994 to 2007. And when the last big recession hit, I was running our land development division and our high-rise tower division. And so we kind of got the message very early in both those departments that the recession was going to be of epic proportion. So I immediately pivoted and went out and started to raise money and find friends that believed that the recession was going to be an epic opportunity. And Starwood has always, as you just mentioned, Starwood Capital has always had kind of a contrarian and a special lens to look through with, recessions and recoveries and so forth. And so we interviewed with several different private equity groups back in 2006. And towards the end of 2006, we kind of determined that Starwood was going to be a great resource and would invest in the darkest of days. And that's exactly what happened. So Starwood Cap had a contrarian view, as did we. We were kind of predicting 25-30% home price decline back in 2006. John Burns and I were just getting to know each other and respect that. And he thought, wow, you guys really think things are going to get ugly. And as we all know now, with the benefit of hindsight, in many locations, that was underestimating the impact. And so
remember, Mike, all the soft landing conferences and talks and headlines like, oh, come on, it's going to be a soft landing. And that was always a pipe dream.
So there's I'll remain unnamed, but there was our second choice of equity was a different group that is a very famous individual. And he said to us in late 2006, he said, hey, this is going to be very, very ugly. He goes, but the initial deals that come out when the recession starts, he said, you're going to think they're really, really good deals. He goes, but then it's going to drop another leg in a big, big way. And then you're going to start to buy deals. And he is 100% right. The stuff that we bought in 2007 and 2008 pales in comparison in the stuff that we bought in 2009 and 2010. The stuff we bought in 2010 was simply magic. You really bought stuff for 10 cents, 15 cents on the invested dollar. And so that was a great business plan. It's not today. It's not realistic today. And Starwood Cap has been a great group to evolve with. So we've been exclusive partners for 14 years and doing residential land development and truly being a spokesperson and helper in anything kind of residential to Starwood Capital, as they have invested in numerous other platforms. They were one of the founding partners of Invitation Homes, what's now known as Invitation Homes. They obviously formed and founded TriPoint Homes. And so they've been a great partner for us. And we feel like we've been that kind of reciprocal partner for them and kind of boots on the ground type intel of what's happening in the land and home building world, since 2007, really.
Yeah, you do have that kind of partnership because I think of you guys as land and money, and that is a great relationship with Starwood Capital.
we've been very lucky in that respect, and we've got a great team here at Starwood Land. With our back office is extraordinarily strong, and so we're able to report in the private equity way and provide as much granularity and detail as they like, and I think that combination of money and talent as it relates to the development side. We got offices today in Florida. Our main office, Starwood Lands in Florida. We have a small satellite office in Denver and one in LA. So we can actually kind of move and pivot and provide intel in a lot of these markets. Obviously, the John Burns relationship helps too. So we've been, very lucky with that one. But we're able to kind of provide that intel and in a sophisticated kind of at the typical private equity level that they would expect.
So you guys started, as we talked about, kind of with the S&L. You guys really started, honestly, by taking distress in the market and turning it into something of value and seeing that kind of vision just a few years later. Is there any part of that approach that you can still do today? Are things just so completely different? Your approach has to be radically different than what it was those years ago.
It truly is dramatically different now. In fact, when we first partnered with Starwood Cap, there were many people that would say, "Oh, we have $100 million fund, to acquire land deals." Well, now they have $1 billion fund or $2 billion, and so Starwood Cap's Fund 12, I think, is like $10 billion in equity and probably at least that in debt. So the world has grown exponentially as to the size of deals and flows that are out there. And distress does not exist. So you've got to really kind of try to find what we add value to. And what we, in the residential business, what we add value to today is, a big portfolio where we could kind of multitask across numerous markets. There's only a handful of developers that are actually doing it in multiple states at the same time. And so that's a way we are being able to pivot and underwrite a tremendously diverse group of assets. When 2018, we got in a nasty bidding war with D.R. Horton on that 4-star transaction, and as the world knows, D.R. Horton won the battle, and they ended up acquiring 4-star. But that was a very unique company that had oil and gas interest and timberland and multifamily apartments and a fair amount of residential communities too. And so with Starwood Cap's oil and gas team and our resi team and multifamily teams all combined together, we were able to do that very, very quickly and value that company. Unfortunately, the folks at DR won that war. We did win a little bit of the battle. We were able to buy 21 assets from them for about $230 million at the end of 2018. And so we've developed the vast majority of that portfolio out now. So it's kind of on the tail end.
Is that kind of a key appeal to you, a target that might have sort of varied interest and sectors within various real estate?
That certainly sets us apart because Starwood Cap has just about every vertical that's out there, industrial and commercial. And so we can compete on a very diverse group of assets at one time. So that makes them an even better partner from that perspective. Truly, the land space you were asking earlier, is it different, the distress cycle? Yes, there was recently a large tract in the western half of the United States that was marketed, broadly marketed. They had 10 offers north of 200 million for a one master plan community. And so that would not have happened 10 years ago, obviously.
Mm-hmm. No, it does seem like anything is fair game. We'll talk about land in a bit. That's coming up. But when you approach an investment, a potential investment, do you have kind of a template approach, or is it very case by case, opportunity by opportunity?
Yeah, if it was programmatic, it would be easy, but there's nothing easy. And every deal has that we look at today has tremendous amount of hair and complexity on it. And so if it were not hairy and complex, the big public builders they have access to extraordinary amounts of capital, and the privates that are left are typically well financed as well. So you can't discount them just because they're privately held. They have access to big dollars. So if it's a mainstream type land deal, anywhere, call it 1,000 units even, the competition amongst the builder group is robust. And so that kind of makes it difficult to leave your developer margin in the deal. So, our deals will typically have some entitlement issues or redevelopment plans or various, complexities to them.
Are you really is it kind of a button down approach and heavy on the quantitative? In other words, do you have to show here, we're going to get a specific return? We're going to show that with hard numbers. Or do you ever approach things with your gut to kind of go with your gut, a little softer outlook?
No, I don't. I don't think much of our stuff is gut. It's more truly qualitative information that is, something that, what we know what land is trading for and what builders will pay for lots or what, multifamily folks will pay for a door on a, apartment complex or what commercial space is going to sell for industrial. We will take our very best guess at all the complexities in that specific project and truly support and analyze, comps in and around that area. But again, we do need the project to be complex with a multiple disciplines to be competitive. And so we are uniquely qualified to underwrite and evaluate all those complexities. So that kind of is one of our focuses, is trying to find those deals that are, big and complex, but also we can underwrite them. We're not going to use the term precise, but with very good measure.
I'm glad to hear you say that because we're a consulting company and a research company, so it's good to hear you say that you want to have some evidence behind it. But there is that old school kind of developer image of cowboys and stuff like that. Is there anybody out there who's approaching this kind of cowboy style in your space?
Oh, there are a handful. I don't see it institutionally like any of the public builders or anything of that, but there are some sophisticated local people in each one of these markets that will take true entitlement risk, close a piece of land, and for example, it's outside the urban service line, and they would take the risk that they're going to get the urban service line moved. Well, that's not typically what the public or the big private builders are going to do. So each one of these markets has a kind of a well-heeled private investor that will take some of that risk. So I don't see it from an institutional grade, but locally you'll run into those people in a lot of the big MSAs, especially. There's, pick a city, and there's typically one or two guys that have access to capital that will just close on a piece of property that is kind of path of growth, something like that.
Yeah.
So
let's stay on the development part here just for a minute. You hear a lot at conferences or whatever that everybody's kind of afraid of development, of entitlement, of risk right now. But you're just telling us that's a pretty competitive part of your world. Do you kind of know who those competitors are going to be? Is it a fairly finite number of actors, but those actors are really, really competitive? Is it that kind of environment?
You definitely, who you're competing against, and it's a very small industry. So yes, you'll be able to predict 8 or 10 of your competitors on the deal that are out there. And so, yes, it's competitive, but there are certain groups that, as you said, just will shy away from, a substantial amount of the development work. And, every market's different, Dean, as we've talked about. Some markets have, rock and stone and, that gets to be very, very expensive, or they have, in California, you have entitlement issues that can be, years, not months. And so, those are risks that if you haven't done it before, you can easily get caught. And so, that's where we kind of use we're we have enough gray hair guys, including myself, in the room that you know.
You said years for California. You said months, years, and you throw in decades as a category as well in California, because that can happen.
I think that has happened, and
Yes.
we are unfortunately aware of that too personally. So we get it all too well. We like the Southeast United States a lot. The opposite reason, right?
How far back in the entitlement process are you willing to go in the food chain? Will you go, I mean, just absolute pure raw land? Are you even attracted to that, or would you prefer to be a little further up the stream?
It's all about the risk and the propensity for entitlements. If it's a true unentitled tract, then the price would be commensurate with that. And so, in every municipality, it's different as to how many months or years that equals, right? And so, in a lot of our markets, if you bought an unentitled tract, you should be able to get to earthwork in, call it, 15 to 18 months. And so, would we buy that? Yeah, very likely we would.
So do you like predictability? Are you know the timeline, even if the timeline is a little bit long as it's predictable? Is that a positive for you?
And we would need to be comfortable with the municipalities and having done business and seen the processes and making sure that they are actually kind of performing and tracking and keeping these projects on a roll.
Where are you focused right now in terms of your locations, your geography?
So as I said, we have a few deals in California that we're managing on behalf of Starwood Cap right now. We actually have assets in Arizona, Colorado, California. We're pretty long Texas right now. A little bit left in Florida, Tennessee, and then the Carolinas really is the primary base of the holdings. The biggest single position would be Texas right now.
Okay. So pretty Sunbelty. Would you consider, if you heard of something in some other location, would you consider, or do you have a pretty defined footprint and you're not going to stray out of that?
No, we're pretty flexible. We'll go to a lot of locations, but one of the key things for us is we do not do vertical improvement. So we are not a home builder. We are a land development team, and we want to be where we have numerous choices of builders. So a lot of the markets that are kind of small markets where you don't have publics and you only have privates, it's truly the market for land and development is there's two types of markets in our eyes. Is one that's got a lot of heavily traded, publicly traded builders and a lot of big, well-financed, like a Tampa and Orlando, a Dallas, a Fort Worth. And then there are markets that don't have that component as much, and that would be like a Kansas City, something like that. And so the number of exit strategies in a Kansas City are different than they are in an Orlando or a Phoenix, where it's a proverbial food court of builders. And, unfortunately, the competition for that land because of that food court is very, very intense.
Yeah, it's really analogous to home builders who their buyer pool is home buyers. Your buyer pool is home builders, but those where there are lots of folks in the buyer pool, it's a really competitive environment.
That's a critical component to know too. Every project you do, you got to know how many builders, are in this submarket and are going to be in this submarket. And we've seen it change where, in any kind of recessionary move, a lot of times the builders will pull out of, certain markets. And, right here in Florida, Vero Beach is an example. We bought stuff in the distress cycle that truly DR was the only one left building over there. And there was one other private builder. And so when you've got one horse to choose from, you can guess who's setting the terms. It's certainly not you as the landowner, right? Yeah. Now there's 10 of them over there.
Yeah. So it's Halloween season almost pretty much. Would you consider like a haunted swampland or like a Native American burial ground potentially? Does that deter you?
No, we wouldn't be on that.
I'm kidding. I'm trying to get in the Halloween spirit here. In terms of product, in terms of housing product, would you do anything? Are you focused on single family? You mentioned you had a history a while ago in high rise, mid rise. Would you do that?
We would. As you saw, though, the Surfside condo collapse, which was a horrible tragedy, has truly changed condo development in Florida for the foreseeable future. So it is our home base here, and we're careful not to compete with Starwood Cap. They have a tremendous amount of multifamily of experience and intensity. So when we do come across a good multifamily tract, we'll typically partner with the Starwood Cap guys on their multifamily team and let them develop that out. But we're looking at multiple tracks that are now we're kind of calling them horizontal multifamilies, which is really the built to rent product that is out there. More cluster design, not 3 units to the acre, more like 7 or 8 units to the acre.
Now, you're involved with Starwood on the build for rent, the BFR side, kind of at the fringes a bit. But you predicted, don't be humble, about 3 years ago that the build for rent folks would be able to pay top dollar and outbid anyone else. That's come true. It's a given now. Why is that so? What are the mechanics of that?
Well, a lot of the build for rent folks are trying to acquire as many land deals as they can and houses as they can. And so just the scarcity of supply, as you guys all report regularly, the average month supply of resale homes is probably 2 across most markets, where it should be 6 or 8 months supply. So a lot of that is because the build for rent folks are buying those houses up. And so as the supply has dwindled, they've gotten more creative, and now America's Home for Rent's got their own home builder. They're out buying land, and numerous people are out buying their own land tracts, and so they're actually designing product that I don't find necessarily attractive, but it's attractive to the renter. It's a single family product. It's detached in many locations, but it's yielding 4 to 8 units per acre versus the traditional old ways of doing things of single family development. You would get 2.5, 3 units per acre. So it only stands to reason if the guy doubles the density, he's going to be paying a lot more for that land. So if you're a land seller, John Q. Farmer out in Osceola County, and the guy's saying, "Hey, I'll pay you $90,000 an acre," versus the public builder wants to pay me $50,000 an acre. You just don't have to care what he's going to do with it. So those guys are paying up and can do it. And it makes economic sense for their business model. So it's not they're overpaying. It makes sense for their model. It's a different model.
I was kind of going to ask that. I mean, do you ever feel like at all there's a little bit of froth in there and that there is maybe too much money chasing that space? Or is that not so?
There's way too much money chasing that space. I'm confident of that. I think I joked at one of John's conferences about 3 years ago that on the residential land business, I feel like I'm swimming in a hot tub full of cash, and I just have no projects to spend it on because there's $10 for every $1 of good deals that are out there. Today, that hot tub has become an Olympic-sized swimming pool.
Yeah.
And half of that pool is the build to rent folks. And so there's $1 and now there's $100,000 available for it. Mm-hmm. So there's tremendous appetite for that product. And I'm not so sure all of them are going to get satiated with their demand. So it's creating a bit of an anomaly on the land environment. And we'll see how that kind of plays out in time.
Well, now you just have to have goggles and Speedos to play in that world instead of, a martini.
That is correct.
Tell me if this is getting too far afield in the BFR world for you, but do you feel like there also might be too many potential operators out there in the BFR space? It seems like everybody is at least looking at it right now.
I think there are several operators. I think from what we've seen, there are fewer that are really, really good at it. And it's difficult. It's a very difficult business. That's why I've steered clear of it. We have 14 employees versus, several thousand. When you own 10,000 houses, you got to have a couple thousand people managing that. And that's just very, very labor intensive. And it's a hard business to perfect. And so I applaud those that have created the platforms that are doing it and making it work. Starwood Cap is on it again. They're doing it again. And so they're one of them. But it's hard. It's very, very difficult to do. And the operators are finding that out. But they have seen incredible rent increases. And so guys like John Burns can opine better than I how the sustainability of that looks. But a lot of the rents that I see now are simply eye-popping to me that I would have guessed 3 or 4 or 5 years ago.
Yeah, I think honestly, as a sector, I think it's here to stay. It's going to be growing. It makes sense that it's growing, but I think there will be some folks doing it that maybe because of their inexperience, or maybe because of just their outlook is maybe a little overly optimistic. There's going to be some mistakes along the road here. Just my gut. How about, Mike, in terms of markets? Do you look at those in that quantitative way? Are you constantly assessing markets in terms of where you want to be?
We are. We're very, very careful because every market is different, as you know. We went long Arizona in the recession, Phoenix specifically, and that recovery was slower there. It was a number one market in the country for many, many years in that 04, 05, 06 range. And the recession, kind of crippled it. And, we bought stuff that we thought was extraordinarily cheap, and it took a lot longer to recover. And so that was an interesting play. But now not only has it recovered, it's actually seen a giant hockey stick in land prices and land value. And so, we were green light there 2-3 years ago from a residential space. Today, we look at that with caution. So I would consider that a yellow light. And so, it's yellow lighted, much like an LA or a Portland or a Denver. They're not red lighted. We're not going to block them out, but we're going to just be pretty careful when we go there.
And you see, that's a great example, by the way, of how much just craziness can play a part in the actual outcome. So Phoenix is a good example. You're right. Everybody looked at Phoenix. And I think it was very rational of you to look at Phoenix and say that market's going to come back. But I remember that it took a long time for that market to come back. And I don't think anybody predicted that. And then the incredible strength of that market recently was also very, very hard to predict. There's a lot of mistakes that can be made in that kind of timing sequence, isn't there?
There really is. And Phoenix was an interesting play. Phoenix kind of started to recover in 2011, 2012, and then 2013, I can't remember the event that happened, but Phoenix took a precipitous drop down again. Unlike a Dallas or a Houston or Orlando even, we were selling lots in Phoenix and Orlando at the same time, and it was 2 separate markets. It was amazingly robust in Orlando, and then Phoenix was kind of like a lot of builders bought a lot of stuff in 2011, 2012 thinking, okay, Phoenix is going to blow back up and go back up to that 45, 50,000 starts a year type environment. And it's been a while since I've looked at those numbers, but it was kind of tracking, going back towards 15 or 16,000, I remember. And then it kind of took about a 2,000 or 3,000 blip down. Unlike a lot of markets didn't have that blip down.
And that's what I mean. That was a rational expectation in 2011 and 12. Say, okay, this market's going to continue upward, and it didn't. It's sometimes funny how flips of coins can impact outcomes so dramatically.
It's certainly hot today, though. It is certainly hot today,
especially in the BFR space. It's there's nothing close to it.
Right. That's the incubator for that market, and the land prices and lot prices have gone up dramatically. You're going to see house prices climb there rapidly. And that's when we're going to see, where is the ceiling for that product? But I don't know that we're there yet, because I think the folks relocating there are coming out of more expensive places like California, like Portland and so forth. And it's still relatively affordable.
Oh, hugely. By California standards, is immensely affordable. What will be interesting to see how this whole kind of great migration thing, as folks like in the tech space pull people back into offices, will those people still be able to work from home from Phoenix or not? That's a zillion-dollar question, kind of.
Yeah, we see it in Florida too. I think there's a tremendous influx right now I was just having lunch with a higher end builder in the Tampa market, and He just said to me that 50% of his buyers were reloads from the Northeast. And so that's up threefold from what it was 3 years ago. It used to be 15, 20%. And now it's close to 50% reload to from out of the Northeast United States. That's a big
Yeah,
number for Tampa.
that's a huge number. And the question is that a permanent relocation or dislocation in the market, or is it something that will trend back to the norm? My guess is it starts to trend back to the norm, but we'll see.
Yeah.
How about in terms of the different sectors within residential? I know you're not directly involved with apartments, but just your sense, do you rank for sale versus true apartments versus BFR? What are you looking after most days?
We are truly trying to service the big public builders and the big private builders. So, we are trying to source, a large master plan community where we could have, 3 or 4 or 5 builders in the project at the same time. And, that's our specialty. We like to build amenities, build infrastructure, create the place, if you will, and bring in complementary builders to the stack, if you will, and, kind of small, medium, and large type products. And each community is different depending upon, which builders are in that market. And so our focus is really the for sale, kind of resi business. In almost all these communities now will end up with some apartment land or some multifamily land or even some land that kind of lends itself to the BTR guys. And we've sold land to, multifamily apartment developers as well as BTR folks.
Okay. Would you actually have, I know this is kind of a hot topic too. Would you, as you're developing a master plan, you have X number of neighborhoods, would you consider selling one or more of those neighborhoods off to a BTR or developer with the rest being for sale?
No, it's actually, we're doing that. We just did that in a project in Houston, actually. And it requires, you've got to have HOA documents amended and you've got to have, be prepared for that and talk about usage rights of the amenities. And, so it creates some complexity. And in various markets, you have district bonds and stuff like that impact, the rentals economics. And so they're kind of adverse to that. And so you've got to work around those kind of elements. But again, they can pay a premium for that lot that we're developing. So in our case, as long as we feel that it's complementary, it will not be a product that's going to, dilute our builders that we're trying to sell, retail lots from, and they're going to maintain and keep things, maintained. I think that's always a critical element with the rentals is getting comfortable with, the maintenance program that, the owners are going to keep in place. So we kind of prefer to deal with an institutional rather than sell, 30, 40 houses throughout the community dispersed to, various ventures. We'd rather sell, 100 lots to one group and kind of create their own section and require a maintenance plan in place with that group. And that lends itself to the institutional investors.
Yeah. Okay. Does the land market scare you in the sense of, do you worry that there just isn't enough land for demand out there, available, entitleable, developable land?
I've been saying this for 3 or 4 years now. I really believe that every municipality is harder. I joked at the last conference. I said, raise your hand if you're in a municipality where it's easier to get things done than it was 3 years ago. And of course, everyone laughed and no one raised their hand. And I said, raise your hand if you're in a municipality where it's extraordinarily hard or much harder than it was 3 years ago. And about 3/4 of the room raised their hand. So even some of the smallest of towns and areas are getting very granular and very detailed and adding additional costs to these developments. So it's making it harder. I've consistently thought that, 1 million new single family starts a year is about what could be engineered and entitled. I don't know how we're going to ever see 1.5 million like we saw in 04 and 05, 2005, 1.5 million new single family homes. I don't think there's enough land in the way. I don't think it's being entitled and engineered and can get out of the entitlement process fast enough. And that's what you're seeing right now. Obviously you've seen a couple of the builders report supply chain shortages. I believe the biggest supply chain shortage is land. Now, obviously windows and doors and all that stuff is, short as well. And I'm hearing paint now is, one of them, but those don't impact me, but they impact my builder, which then impacts us because, um, we're trying to put as many lots on the ground as we can, and as soon as we get them on the ground, they're bought up, and that's because I believe the biggest bottleneck in the in the cycle is land, and that's the true throttle for how many new home sales are we going to see in 2021. I think it's going to end up below 800,000.
Wow. And that keeps a kind of a governor on supply, which is, in terms of this market not imploding, is a good thing.
I think it's inevitably price increases too, and so we've got to monitor that very, very closely. You're seeing a lot of these markets with 20-25% home price appreciation in 12, 15 months. That's dangerous, and that's dangerous in a lot of spots. So, you pick an MSA, in Nashville, there are parts there that you've seen 30% price increase in 12 months. And so, that's now getting to a product that's a $700,000 house. Well, if interest rates kind of, I call it stabilized, if they went back to some sort of ordinary, I mean, you and I are of comparable age. We used to think 6 or 7% was kind of ordinary. I think vast majority of these buyers have never seen anything but 3 or 4% rates. And so if it popped to 5 or 6, that house that's selling for 700 today has got a bad day coming.
Oh yeah, I mean, it would just jump their monthly well beyond their means. Yeah, I mean, even folks, we're funny, even folks in really high-end markets like Silicon Valley, they're buying $1 million+ townhomes. But trust me, those folks are stretched. They cashed out their Google stock and whatever. They're stretched. They're not putting much in upgrades in there. They're stretched to buy that. They can afford that $1 million to townhouse, but they're stretched for that. And yeah, the 3% or whatever mortgage rate, that's huge for them. Do you think land prices might be too frothy? I think I know the answer to that, but I have to ask. Are they fair right now?
I think in many locations, and again, even in MSA, there's 10 locations within Tampa, there's 10 spots you could buy land. I would say 2 or 3 out of those are overpriced, and you got to be careful. But I would say many of the markets are still relatively affordable. I think the average new home price in Tampa, for example, last year was low 330, something like that. That's still pretty affordable.
Yeah. On a national perspective, yeah.
15, 18,000 homes a year. Lenard, I think they did 3,500 homes in Tampa last year, and their average price was probably in the low 300s. That's pretty affordable.
Yeah, relatively, sure. Especially if your buyers are coming from the Northeast or California, where they can cash out for a good chunk of change. That makes a lot of sense. Let's end with my favorite thing, which is having you go on record and predicting stuff, so other people like me can gloat later on if you're wrong. And let's just do it at the kind of the market cycle sense. There's always that baseball innings analogy. Where are we in the whatever inning? I mean, in baseball, I think I've said this before, but in baseball, you can bat around and you can extend that inning for a very long time until you've made that third out. And it seems like that's what we're doing. Do you see this as continuing? Maybe not the 25, 30% appreciation, but you see a solid market fundamentals continuing for a decent length of time going forward?
I do. And in a lot of the more pro-growth states, and I see, I think it's going to be much like the last recession, but it won't be anywhere deep like that. But I think it's impactful like that. And, the last recession, Texas was, I'm not going to say unaffected, but not affected hardly at all, like Florida was. And Washington, D.C., it didn't have as much impact as it did in Washington as it did in Florida. So it's going to be cyclical, and it's going to be in different municipalities. It'll all be different. But I would tell you, yes, if if you asked, what do I think the new single family home, sales, like I said, I think this year it probably ends up somewhere around 800,000. Um, and I see that for the next 2, 3, 4 years. It's just, where are those 800 going to be built? And so I think, some of the pricier locales, they may not be happy. But the affordable locales, Long Texas, not all of Texas is affordable, as you know. I mean, different pockets are, pricier. But
Austin. Yeah.
I think that you're going to see, a DFW will continue to grow. It's going to continue to, uh, attract buyers, and it's a diverse economy. Houston proved its diversity in this last little blip. They had negative oil rates. Oil was trading for a negative number. If you remember, that was what, April of last year, and Houston kept selling houses. I think it's a more diverse economy. It's very affordable. It's a pretty desirable place to live. No state tax. It's got a lot of reasons there. It's hot, just like it is in Florida, but um, so I believe that my short answer is yes. I think, unfortunately for me, a guy that thrives on the distress cycles, I don't foresee that distress day coming back, and I hope it does before I retire. But
So no more pennies on the dollar days for you.
I hope I get one more of those before I retire. But I'm one of the few guys in the room that wants to see it collapse.
I know, you really are. Well, that's great, Mike. Thanks so much for coming on. That was great. We learned a lot about land and the land market today. That was super helpful.
Greatly appreciate your time, and you guys have a good day.
You too. Awesome. Okay, thanks a lot. This is Dean Worley for the New Home Insights podcast. We'll see you next time.